Welcome to those of you that have joined. We've just opened the live link, so we're just waiting for a few minutes to allow everyone to join before we start. Welcome to those of you who have joined. We've just opened the live link, so we're just waiting for a few minutes to allow everyone to join before we start. Welcome to the Five Stone Buildings webinar programme. We've just opened the live link, so we're just waiting for a few minutes to allow everyone to join before we start. Whilst we're waiting, I will just remind you of the house rules. Just to remind you that this webinar is being recorded. If you have any questions throughout this webinar, please put your questions into the Q&A box at the bottom of your screen, and our speaker will try to answer at the end if we have time. If you do not wish to be identified when asking your question, please tick the anonymous box so that our speaker does not identify you in their response. Finally, I would just like to remind you that we now have a separate section on the Five Stone Buildings website for webinars, where you can find a copy of this recording and any slides used and recordings of all previous webinars. I will now hand over to our speaker, Harry.
Thanks very much, Kira, for the introduction. Good afternoon to everyone who is attending. Thank you very much for coming along. I'm not sure I particularly sold the webinar with my topic of when is capital gains tax payable on the settlement of chancery litigation for a Friday afternoon, but hopefully you'll find it of some interest. So by way of introduction, CGT is a relatively new tax. It was introduced in 1965. And we're probably all familiar with the idea that it's a tax on the gain made upon a disposal of an asset. And particularly as litigators, but also as other practitioners, we've clearly got in mind the idea that when someone disposes of a tangible asset, like a house, for example, there might be a chargeable gain there, and therefore a charge to tax if there isn't any relief. And we have a similar idea in mind with intangibles as well, for example, on a disposal of shares. But it might not always be at the front of our mind that rights can be assets for capital gains tax purposes, and therefore a chargeable gain can arise when a right is disposed of. And particularly as litigators, we need to have at least an awareness of when we might be triggering a disposal of rights. So in this webinar, I'm going to look at two types of rights: rights to sue and rights to an unadministered estate. And I'll start off with rights to sue, which will probably take up the majority of my time, and I think is a point that comes up more often in practice and is more interesting. And I'll deal with rights to an unadministered estate towards the end. So turning to rights to sue, where are we now? I've tried to set out in bullet points on this slide what the current position is as far as I understand it. So the first point is that a right to sue is, or at least is capable of being an asset for capital gains tax purposes. A right to sue is usually acquired for nil, which is an important point because it often means there isn't any acquisition cost to offset against the consideration that's received. The third point is that a right to sue is disposed of when a court judgment is entered or a settlement is reached. It's at that point that the right to sue is turned into money or some other form of consideration. The consideration for the disposal is going to be the value of what's received, so under the judgment or the settlement. And the combination of that and the nil acquisition cost means that CGT may well be payable on the entirety of the sum received. At the moment, HMRC operates a non-statutory concession whereby the first £500,000 received is not charged to CGT, but it's possible for anything above that to be charged. And in the following slides, I'm just going to break down those summary points in a bit more detail. So the first point is what is an asset for CGT purposes, particularly having in mind rights to sue. And I've set out the two key sections of the legislation in the first two bullet points. So section 21(1) says that all forms of property are assets for the purposes of capital gains tax. And this includes incorporeal property generally. So that if you've got a right to sue that is property, then it's likely to be an asset for CGT purposes, and rights are obviously fall within the definition of incorporeal property generally. And then section 22 tells us there is, for the purposes of this act, the disposal of assets by their owner where any capital sum is derived from assets, notwithstanding that no asset is acquired by the person paying the capital sum. And this applies in particular to capital sums received in return for forfeiture or surrender of rights or from refraining from exercising rights. So that section makes it even clearer that rights are capable of being assets, because that's one of the examples that's given. And that section is also telling us what a disposal is. A disposal occurs where any capital sum is derived from assets. So the idea of an asset and the idea of a disposal very widely defined in the legislation. And you can see in 22(1)(c), the legislation tells us that there's a disposal of assets when a capital sum is received in return for forfeiture of rights. And that is a pretty good summary of what a settlement agreement is. It's an agreement that someone won't pursue their rights in return for a sum, quite often cash. And that quite clearly seems to be caught by the legislation. The leading case on this is still the House of Lords decision in Obrien and Benson's hosiery from 1980. I've put the citation at the bottom of the slide. And in that case, Lord Russell, who gave the only reasoned judgment, said that an asset for CGT purposes was simply something which can be turned to account. And that echoed the submissions for the Crown that were made in that case, that assets for CGT purposes are all forms of rights upon whose disposal a capital sum may be received. The facts in that case were that an employer paid his company £50,000 to be released from his service contract. He had another 5 years to work for the company, and instead of serving out his time, he paid off the company. And the House of Lords held that there had been a disposal of the company's rights, or of an asset by the company being the rights under the contract, in return for which they received £50,000. That wasn't a straightforward decision at the time. The House of Lords overturned both the special commissioners and the Court of Appeal in coming to that conclusion. The lower courts had reasoned that the company hadn't disposed of any rights because the rights that it had under the contract with its employee were not assignable to anyone else, and they didn't have any market value. They couldn't have been sold to anyone else. I think that's by virtue of them being rights under an employment contract. And the House of Lords said that doesn't matter. As long as you have a right that's capable of being turned to account, then you have an asset. And in that case, the right was capable of being turned to account because the company received £50,000 in return for not holding the employee to the rights under the contract. If you consider that definition for a bit, you can see that it's circular and it's self-fulfilling as well, because a capital gains tax charge is only going to arise where there's been a disposal, and that is where a capital sum is derived from an asset. And when we look at what an asset is, it's anything from which a capital sum can be derived. So analytically, not that easy to break that down. The practical effect of it is that it draws almost anything within the charge to CGT if you can receive a capital sum in return for disposing of it. These principles, and in particular Obrien, were applied in the case of Zim Properties and Proctor, specifically in relation to rights to sue. So Obrien, the case we just looked at, the House of Lords decision, wasn't concerned with rights to sue, it was concerned with rights under a contract. Zim, however, was specifically concerned with rights to sue. And it's just important to have in mind the Obrien case when considering Zim. Zim seems to be the decision that's more well known because it did establish that a right to sue can be an asset. But it's important to bear in mind that Zim is the result of following a House of Lords authority. So whilst Zim is only a first instance decision of Mr. Justice Warner, it's probably here to stay with us unless it's overturned by statute, because it is following a decision from the top level of our judicial system. So in outline, the facts in Zim were that the Zim Properties claimed against its solicitor in negligence. Zim alleged that it had lost a profitable sale of land because the solicitors had poorly drawn the sale contract, and it had allowed the buyer of the land to escape using a technicality under the contract. And Zim therefore lost out because of a change in the value of the land between the time of contracting and the time that the buyer pulled out. So Zim asserted the claim against the solicitors. It was in fact issued and they began to litigate. And then the solicitors' insurers settled the claim for £69,000. Many years later, so that all happened in the 1970s, and in the 1980s, Zim entered into a dispute with the revenue as to whether and how that receipt of £69,000 was taxable. Mr. Justice Warner held, as you'll see on my second bullet point and the sub points under that a right of action does constitute an asset for CGT purposes. So Zim's right to sue its solicitor was an asset for these purposes and therefore capable of being brought within the charge to tax. And following Obrien, Mr. Justice Warner said that a right to sue can be turned to account by a negotiated settlement involving the payment of a substantial capital sum. And therefore, because the right is something that's capable of being turned to account, it is capable of constituting an asset. He did say that he reached that conclusion with considerable hesitation, and therefore I don't think it was a straightforward conclusion for the judge to find that a right to sue would be chargeable. But that is the decision that the judge came to, and it's been followed since 1985 to date. The judge also held that the payment of £69,000 was derived from the right of action against the negligent solicitor, not from the underlying land, which was the subject of the sale. As the law stood at the time, the judge held that Zim had acquired the right to sue when the defective contract was entered into, and it had acquired the right at the market value at that time. That part of the decision is important, and it was possibly correct at that time, but for reasons I'll come on to, it isn't correct anymore. at that time, it was true that the right to sue was acquired at the market value at the time of acquisition. That rule was in fact removed in 1981. So that rule had been removed by the time Zim was decided, which was 1985. But because the case had taken so long to work its way through, the gains actually arose prior to 1981, in fact, in the 1970s. So the old rule still applied and the right to sue was acquired at market value. It's worth noting as well that the timing point is probably wrong as well. There's been a lot of disputes post-Zim dealing really with limitation. Obviously, limitation is going to start to run at the time that the cause of action arises. And it might be thought fairly alarming that in all cases, the right of action actually arises when the defective sale contract is entered into. There's obviously been a lot of argument about that. And I think that has made some headway in determining that the right of action and therefore the right to sue might arise later. So that part of the decision, possibly questionable. But the point about acquisition at market value, correct at the time before the law had been changed. The result, as you'll see on the last bullet point, is that Zim was therefore liable to CGT on the £69,000, but it did, however, have an allowance in respect of the market value of the right of action at the time of contracting. So in the end, that wasn't a terrible decision on the facts. The value of Zim's right to sue had changed over time because the value of the underlying land had changed. And tax was chargeable on the change in value of the right over the time that Zim had held it. One other interesting facet of Zim is looking at the arguments that were run for the taxpayer in that case. Obviously, the taxpayer was looking to argue that Zim hadn't disposed of an asset because the right to sue a solicitor wasn't an asset. And counsel for Zim really pushed the point that it would be absurd to conclude that every right to a payment is an asset for CGT purposes. And using the words of the submission, he said it would be manifestly ridiculous to treat a right to the payment of costs at the end of successful litigation as a chargeable asset. And that seems to me to be a really good example of how this, if correct and if taken at face value, could be taken too far. At the end of litigation, the successful party usually has the ability, I would say the right, to claim a costs order against the losing party. That right is capable of being turned to account. It might be turned to account because the parties agree on the costs, the liability for costs and on the payment that should be made. Or it might be turned to account because the court makes an order. If you look at the Obrien definition, it's a right that's capable of being turned to account. But has anybody ever accounted for CGT on a payment of costs? I have never heard of it. And asking around chambers just to check, no one else has ever heard of it either. So certainly the practice wouldn't be to return that sort of disposal of a right as chargeable to CGT. And Mr. Justice Warner didn't deal directly with that example, but his answer was to say that he had no difficulty in accepting that not every right to a payment is an asset within the meaning of the CGT legislation. The interpretation of the legislation requires the exercise of common sense rather than just the brute application of verbal formulae. So he seems to have left the door open there for the application of common sense. And his statement that not every right to a payment is an asset doesn't sit that comfortably with what the House of Lords said in Obrien, which is that if a right is capable of being turned to account, it's an asset. I think that, to my mind, that is quite a useful opening of the door in Zim that might start to explain why something like costs, sum received in return for costs, is not going to be chargeable to CGT. But as far as I know, there aren't any decisions yet that have taken that dictum and run with it and applied it. The next point to deal with is acquisition value. So when someone acquires a right to sue, at what value are they taken to have acquired that right? And in my opinion, it's here that we have the real trouble and the real unfairness in taxing rights to sue. And I think this is more troubling than the decision in Zim, which just says that rights to sue are assets. So the basic rule is contained in section 17.1 of the legislation, which I've set out at the beginning of the first bullet point. So this says a person's acquisition of an asset shall for the purposes of this act be deemed to be for a consideration equal to the market value of that asset, where he acquires the asset otherwise than by way of a bargain made at arm's length. And this is what is known as the market value rule. And aside from the exception that I'm going to come on to, that's normally going to apply to a right to sue, because a right to sue is not acquired by way of a bargain made at arm's length. It's really a matter of the operation of law, that usually that somebody suddenly acquires a right to sue. They don't usually acquire it by way of a disposal from somebody else. Obviously, I'm accepting here exceptional circumstances where a right to sue might be sold, for example. And that was the rule that applied in Zim, and that made that decision quite palatable, because as I have said, Zim, the taxpayer, was taken to have acquired its right to sue at the market value at the time that it was acquired. However, this rule was cut down in 1981 so that the market value rule does not apply where there is an acquisition and no corresponding disposal and consideration. So you'll see that in subsection 2, which is set out at the bottom of the first bullet. So that says subsection 1 shall not apply to the acquisition of an asset if A, there is no corresponding disposal of it, and B, there is no consideration in money or money's worth. So this disapplies the market value rule in almost all cases that are dealing with a right to sue, because a right to sue is not, where a right to sue is acquired, there isn't a corresponding disposal, and there's no consideration given either. This means that in most cases, a right to sue is going to be acquired for zero, rather than at the market value at the time of acquisition. This rule doesn't make much sense to me. When a person who has a right to sue disposes of the right, they have not made a gain in any common sense way of the entire amount of the consideration received. In most cases, they've probably made no gain at all, because when they acquired the right to sue and when they disposed of it, it was worth the same. In my view, the fair position would be that a right to sue is acquired at the market value, as it was in Zim. And therefore, if you're looking to charge a gain, the gain is just the change in value, the increase in value of the right over the time that it's been held. So between the time of acquisition and the time of disposal. And in many cases, there won't be any gain at all. In some cases, the value of the right might have gone up, and therefore a small amount of tax might be payable. Another reason that I don't consider this part of the legislation to be particularly fair is if one looks at the reason it was introduced. As I've said, the starting point since 1965 till 1981 had been that the market value rule would applied. And section 17.2, which switched it off, the reason for that had nothing to do with rights to sue. Rights to sue are just affected by this change as a matter of collateral damage. The reason that this part of the legislation was introduced, as I've put on my second bullet, by the Finance Act 1981, was to reverse a very particular tax scheme called a reverse Nairn-Williamson arrangement, which probably tells you most of what you need to know about it. And this was a completely different world. It was shareholders using a tax scheme to exploit the market value rule. The basic idea was that if you had a shareholder holding shares which showed a large amount of gain, the company could issue further shares to that shareholder. And that isn't a disposal of shares by the company to the shareholder, it's just an acquisition of shares by the shareholder. And the shareholder would then say, well, all of the additional shares that I've acquired have been acquired at market value, because that's what the market value rule says. and that would vastly reduce the gain across the entire amount of the shares, because a lot of them would have been said to be acquired at market value. So this was just a scheme that was exploiting the legislation, particularly in relation to shares. And what's now section 17.2 was introduced so that that scheme wouldn't work anymore. It's just that it's gone far wider than that, and it's affected all sorts of other situations that were not in contemplation when that part of the legislation was introduced. So it's really throwing the baby out with the bathwater to start taxing rights to sue as if they were acquired for nil, not what the legislation was intended to do. And just to press that point home even further, if one looks at the other case law that was decided around the time of Obrien and Zim in the 70s and 80s, none of these cases had to deal with this particular rule as to the acquisition value being nil rather than the market value. The first three bullets on the slide show the three key decisions in this area. The only one of those in which there was held to be a charge to CGT was Davenport and Chilver in 1983. And that was a case about statutory compensation for after assets had been confiscated in Latvia. And the judge found that the right to compensation was an asset for CGT purposes, but because it was decided before, or it was decided after 1981, but in relation to rules that were enforced before the rule change, the right to compensation was acquired at market value, and therefore the charge was a small one. So the judge wasn't having to grapple with the consequence of that decision that might mean that the entire right to compensation was chargeable to tax. The other two cases, the first and third on the slide, Davis and Drummond, in those cases there wasn't a charge. They were cases about statutory compensation following surrender or termination of a lease. Even if there had been a charge, it would have been assessed under the old rules because they both concerned tax periods before 1981. But in fact, the Crown argued those cases in quite an odd and restrictive way. And it only argued that the payment received was received as a result of the disposal of the lease. And the courts, I think quite understandably, said that's not right. The lease had already come to an end, and then this compensation payment was made. So you can't say that it's a payment derived from the lease. The Crown in those cases didn't argue that the compensation payment or the right to the compensation payment was in itself an asset for CGT purposes that was capable of being disposed of. So the courts didn't have to grapple with that line of argument. Seems very odd to me that that wasn't run, particularly in Drummond, which was decided after Obrien and after Zim Properties. So those cases are anomalous for that reason. They're sometimes taken as being an indication that statutory rights to compensation might not be chargeable to CGT, but in my opinion, they don't say that because that point wasn't actually argued in the decisions. So I'll explain in a minute why there's such a long gap on my slide between 1985 and 2018. But just while surveying the cases, I've put on there a couple of recent first-tier tribunal decisions, which have started to apply Zim again. And obviously this is Zim with the market value rule switched off. So with the idea that a right to sue is acquired for nil. And so far, there hasn't really been a sort of sustained argument and analysis of the idea of how unfair this might be. In Godavi, that was a case about a right to compensation against a bank who had missold an interest rate product. And the first-tier tribunal held that that right was an asset and was capable of being charged to tax. Robinson, a couple of years ago, was a case about the settlement of some company litigation in Bermuda. So the taxpayer had been suing other people involved in a company in Bermuda and had received a payment of £1 million after settling that litigation. And the first-tier tribunal held that that was a disposal of his rights in relation to the litigation, was a disposal of an asset and therefore chargeable to tax. So we see a sort of pattern of the older cases not really having to grapple with some of the consequences of the market value rule not applying. And the more recent cases so far, whilst that is the position that pertains now, they haven't really had a detailed look at what the consequences of it are. So that's a sort of journey through the case law. And the other important part of explaining where we've got to now is the extra statutory concession called D33 that HMRC have been operating. So this concession was first published in 1998, so about 4 years after ZIM was decided. This concession pretty much reversed ZIM in relation to rights to sue where the right of action is derived from an underlying asset. So ZIM probably would have been decided differently because Mr. Justice Warner had decided that the right of action wasn't derived from the underlying property. The extra statutory concession probably reverses that. So the taxpayer would have got the outcome it wanted in ZIM by linking the right to sue and the underlying asset being the land. For our purposes, the more interesting concession was the concession where there isn't an underlying asset. And in that case, the concession said that the disposal of the right was exempt from CGT. So that in a lot of chancery litigation, where there isn't any sort of underlying asset, it's just a right to sue, the decision of ZIM was completely switched off. Practitioners didn't have to worry about CGT disposals in relation to rights to sue because of the operation of the concession. And the CGT manual even today says that this concession was introduced in order to alleviate certain unintended results following the decision in ZIM. So we were left with a position that for about 25 years, the decision in ZIM really went into hibernation. ZIM itself wasn't appealed. It wasn't a particularly bad result because of the market value rule at the time. There weren't really any further cases that litigated that particular principle because the concession was brought in. That meant there was no point in litigating it because these rights to sue weren't going to be brought within the charge. So yeah, hibernation, as I say, from 1988. And what happened next? In 2014, January 2014, HMRC amended the concession. The best explanation that's been given for the amendment is that the revenue considered that the concession was overgenerous. Effectively, they were by concession not collecting a large amount of tax, and they decided that some of it should be collected. That doesn't sit to me that comfortably with the reasoning that the concession had been introduced in the first place to remedy unfairness and because of the unintended consequences of ZIM. So the change that was brought in 2014, and this is the position that we have at the present, is that the concession is limited to the first £500,000 of gain. So that much of the gain is exempt. If the gain, i.e. if the consideration received is more than £500,000, it's possible to apply to HMRC for an extended concession that covers the entirety of the gain. However, this isn't particularly useful in chancery litigation because the guidance states that the right must have been acquired in connection with goods or services, which is a sort of oddly narrow piece of guidance to be applying. It's obviously got in mind actions like ZIM, where there's a negligence claim against the solicitor and there's no underlying asset. In that case, the right is acquired in connection with services, and one might be able to apply to the revenue for the entirety of the gain to be exempt. But a lot of chancery actions aren't acquired in connection with goods or services. Take something like a 75 Act claim or a will dispute or something like that. It's not clear that it's possible in those cases to apply for the £500,000 limit to be raised. There doesn't seem to me to be any logic or any particular reason behind having a limit of £500,000. It's just a figure that's been plucked out of the air for expedience. There doesn't seem to me to be any logic in saying that it's possible to apply for a greater exemption, but only where the right is acquired in relation to goods or services. I don't understand why there should be that limitation on it. I think it's possible that this change, brought in this sort of low-key way by the amendment of an extra statutory concession, didn't get the attention that it deserved in 2014. There was from what I can understand, a pretty big outcry when ZIM was decided back in the 80s that led to the concession being introduced. And there wasn't a similar outcry when the concession was rowed back on in 2014. I think the practical effect of all of this is that between 1988 and 2014, a practice developed whereby practitioners didn't need to worry about CGT on disposals of rights because they were nearly always exempt from CGT. And I suspect that that practice continues to quite a large extent today, even after the concession has been narrowed. I do think that the limitations on the concession, as I say, aren't particularly fair at the moment. And they're also, because of the hibernation of ZIM for over 25 years, there aren't many cases which explain how ZIM should be applied. There aren't, as far as I know, any cases in the Chancery field which explain how it should be applied. So what's the future for the extra statutory concession? Well, as long ago as 2005, the House of Lords said in a case in Wilkinson that the revenue, I'm paraphrasing, the revenue couldn't really decide by concession without a good reason just not to collect tax that was otherwise legally payable. And as a result of that, the revenue had to review all of its concessions. And it's decided in relation to this one that it may be outside of its tax collecting discretion to arbitrarily decide not to collect tax on the first £500,000 of gain. So in 2014 to 2015, at around the same time as narrowing down the width of the concession, the revenue ran a consultation about putting this concession onto a statutory basis, so introducing it into the actual capital gains tax legislation. Now, the revenue proposed as part of its consultation that the limit should be increased from £500,000 to £1 million. But there was no explanation of why £1 million was a better number than £500,000 and why gains over £1 million should be treated differently to gains under £1 million. The consultation didn't give rise to much excitement. I can see from the paper summarising responses that only 16 people responded to it. In the Chancery world, the only respondees were STEP and Mishcon Dorea. Of all of the 16 people who responded, nobody agreed with the plans which HMRC had put forward. The general consensus was that the original concession, so the unlimited concession for rights to sue, should just be legislated. So from the small number of people that responded, the revenue did not get a favourable response to its plan. You'll see on the slide I've put on the latest I could find on what's happening with the consultation. So the government said its intention is to discuss the issues in more detail with those respondents to ensure the concerns they raised are fully understood. And that was about 2015, I think, and it's just been parked since then, no progress. So at the moment, the concession limited to £500,000 remains in force, although it doesn't make much sense and it might be illegal for the revenue to operate it. We'll have to see what happens next. It's a bit of a dog's dinner, really, in the way we've ended up with the law as we have it at its current position. It is worth noting that the capital gains tax legislation already exempts from charge some categories of compensation. So, for example, compensation for personal injury, for discrimination and for defamation. Those are all exempted from a CGT charge, even though you've got a disposal of rights in return for a capital payment. It's not clear to me again why those types of compensation don't attract a tax charge, but other types of compensation might do. It may be that the neatest answer is just to legislate the concession so as to put all kinds of rights of action outside the charge, or a middle way would be to put the market value rule back to what it was, so that the revenue is only charging tax on gains which are actually gains. So in changes in the value of the rights over the time that they've been held, rather than trying to charge the entirety of the sum received in return for a right to sue. So here I've got an example. So my example is Boris dies, leaving his entire estate to Carrie. His son Milo brings a 75 Act claim against Carrie. He's obviously seeking maintenance from the estate. And Carrie settles the claim by paying £1 million to Milo. We can see here that Milo had a right under the 1975 Act. It looks very much as though he's disposed of that right. He's agreed not to proceed to court with his claim in return for a capital payment of £1 million. It seems that that right was acquired for nil, and the consideration he's received is £1 million. So under the legislation, all of that is potentially chargeable to tax. We currently have the revenue concession, which exempts the first £500,000 of that from CGT. It's possible that the balance, the remaining £500,000, might be chargeable to CGT. We can query whether that makes any sense. Why should that compensation payment designed to meet Milo's maintenance need be charged to CGT? So how could Milo improve his position? Fortunately, there are quite a number of options open to him. The first question I've asked is the claim under the 75 Act even an asset for CGT purposes? So is it even possible to for there to be a charge here? It does seem to me that the right probably is an asset for CGT purposes, although there might be an argument the other way. The House of Lords has told us in Obrien that a right which can be turned to account is an asset for CGT purposes. And a 75 Act claim easily falls within that because it is capable of being turned to account. It can be turned into money by a settlement. It doesn't matter that the right derives from a statute and is compensatory in form. The only question mark is whether there's room for the application of common sense, as in Zim. I said that the door had been left open a little bit. Maybe there is. Maybe this isn't the sort of right that's capable of realizing a gain, but that would be breaking new ground to run that argument. I do wonder whether, as a matter of practice, many people consider that there's a CGT charge when a 75 Act claim is settled. It may be the practice carrying on since before the concession was narrowed, and there are good reasons for that practice. Other points. One basic point to remember is that non-residents aren't always going to be chargeable to UK CGT. Obviously, non-residents can pay CGT on disposals of UK land, but not on disposals of rights. So this can be quite useful. So if Milo is actually resident outside of the UK, we might not need to worry about a CGT charge because it's not amenable to the charge. Can be really useful with a 75 Act claim. Third bullet point is probably the most useful one, and it's the possibility of reading the settlement back, in particular for CGT purposes. This is obviously particularly useful with a 75 Act claim. This probably solves the majority of problems when you're looking at something like a 75 Act claim. It does possibly put a particular emphasis on reading back from the claimant perspective. We tend to think of reading back being important for defendants because in this example, you've got Carrie disposing of estate assets to Milo, and she wants to ensure that she's not triggering a gain by passing the assets over to Milo. And that's normally why we look at reading back being important. but possibly it's important from the claimant, from Milo's perspective as well, if we need to try and ensure that there's no CGT charge when he disposes of his claim. The practical view is that I'd be very surprised if the revenue sought to impose a CGT charge on a settlement that has been read back. I think that would just upset too much the practical reality of where we are and what practitioners do. The technical view is that it takes a bit of hard work to work through from the wording of the legislation why it might mean that reading back has the effect that Milo hasn't disposed of his right to sue. In general, the legislation is more focused on Carrie not having made a disposal by passing estate assets over to Milo. It's concerned with saying that the variation isn't treated by a disposal, and it's not so focused on the disposal of the right not being chargeable for CGT purposes. But I think there are ways of reasoning the legislation through that probably give enough ballast to the revenues practice that if the settlement is read back, they aren't going to look to levy a CGT charge. The fourth one is something I've never seen and hopefully will never see, particularly if I'm on the other side of a 75 Act claim, which is to seek a gross settlement sum. So theoretically, it would be possible for Milo to say, if this isn't going to be read back, it's possible that my award is going to be charged to tax, and therefore the award needs to be grossed up so that after I pay the tax, I'm left with what I need for my maintenance. I haven't yet come across anyone running that argument in a 75 Act claim, also not run in a lot of other chancery litigation. I think it would be a shame if claimants started to seek gross sums, but it's got to be an option. If there's a real concern about there being a tax charge, then maybe that's something that needs to be broached. I haven't left myself much time to talk about rights in an unadministered estate. I'll read out the example that I've got here. This is a different set of chancery facts. So Boris's purported last will leaves his property to Carrie. Dom claims that the will is invalid and relies on a prior will which gives the property to him. Carrie settles Dom's claim by a deed of variation which gives half of the property to Dom. So just pausing, just to finish off my thoughts on rights to sue, how do we apply our right to sue analysis here? Dom has a right to challenge the last will, at least a right to go to court for a declaration that it's invalid. And he has turned that right to account by foregoing his right to sue and taking half of the estate instead. Is he triggering a tax charge by doing that? To my knowledge, practitioners aren't returning that as a CGT disposal. It's certainly not a right to claim a sum of money, like the right to sue the solicitor in Zim or like a 75 Act claim. But it is a right that's capable of being turned to account. And that's exactly what Dom has done. He's forfeited his rights in return for a capital payment. This is a sort of example of, I think, why we need further intervention, probably putting the old concession on a statutory basis, because I don't think it is sensible to start charging situations like this as CGT disposals, and particularly disposals where the entire capital sum received is going to be taxed because the market value rule doesn't apply. In the time I've got, I'll look at the other side of the coin, which is rights in an unadministered estate. So here we're starting to look at the defendant side. So we're not concerned so much with the right to sue, but we're looking at Carrie's position of, is she triggering a disposal when she transfers part of the estate to Dom in settlement of his will challenge? So clearly there's a danger that Carrie is triggering a disposal when she transfers part of the estate to Dom. The best outcome we're going to have again is if we can read the settlement back. So if the settlement is achieved within 2 years of Boris's death, then Carrie may seek to read it back under 62.6 of the TCGA, which would certainly mean that there isn't a disposal. One would have to query whether that would fall foul of what's called the extraneous consideration rule, which is the idea that a variation cannot be read back if consideration is given for it, aside from consideration in the making of another variation. And there is an argument that we have a problem here, because in return for making the variation, Carrie is receiving a settlement of Dom's claim. That is, in a contract sense, consideration. This is another example of an anti-avoidance rule that's having effects far wider than what it was intended to. In the context of 75 Act claims, the revenue has had to accept that they just won't count the settlement of 75 Act claims as extraneous consideration. So this problem doesn't arise. I've never understood why the revenue has made that concession in relation to 75 Act claims, but not in relation to other claims, including, for example, settlement of a will challenge. My experience is that the revenue doesn't police this particularly aggressively where the arrangements are reasonable. So the revenue knows why the extraneous consideration rule was introduced, and it wasn't to attack this sort of arrangement. And I don't think they push the point very hard with this sort of arrangement. But to my mind, that just isn't a satisfactory state of affairs. We need to formalise when it's possible to read back when it isn't. And I really, just in the remainder of the time that I've got, wanted to highlight the difficulties that might arise where reading back isn't possible. So luckily this is relatively unusual, but it might apply where the 2-year period has elapsed, and therefore it's not possible to read back under the CGT legislation. The position is much better, at least from an analytical point of view, when the administration of the estate has been completed. So in this instance, Carrie simply makes a disposal of 50% of the property, which she can now be said to be an owner of because the administration is completed, and it could be said that the estate is now held for her. There may not be much CGT to pay in that instance. She will have had an uplift on Boris's death, so she's only going to be paying gain on what's arisen, if anything, after the death. And she may have her certain allowances, annual allowance and other things available to her. The trouble really comes in where one has a variation of the estate before the administration has completed. In this scenario, when Carrie executes the variation, she doesn't have any interest in the estate. All that she has, according to well-settled law, is a right to insist on the estate being properly administered. That would be a right against the personal representative, and to have the funds or assets paid or transferred to her at the conclusion of the administration. If we analyse this, we take Carrie as having that, what we call an administration right, and we say that she disposes of that to Dom. So essentially, she gives him that right in relation to half of the estate. This is hugely problematic. We may find that Carrie acquired that administration right for nil because it's not within the market value rule and she didn't pay anything for it. And there's a danger of the whole value of that right, which is probably going to be linked to what the value of the estate is, being chargeable to CGT. Fortunately, the revenue seems to take a slightly different and more taxpayer-friendly analysis in its CGT manual. And what the revenue says is that Carrie doesn't dispose of her administration right. She in fact disposes of the future proceeds of her administration right, i.e. her future right to half of the property. And the revenue says when the property finally vests, you apply hindsight and you run the CGT calculation. So we end up in the same position as if the estate administration had been completed. So Carrie is only paying CGT on the difference in value of half of the estate between death and between the settlement. I find, whilst the revenues view here is helpful, I find it quite difficult to understand as a matter of logic. The revenues say they take this view because Carrie's administration right can't be disposed of, and therefore she must be disposing of the future proceeds of it. I'm not sure why they say that, because I can't see any particular reason why she can't dispose of part of her administration right. It does seem to me that this is another example of the revenue bending the rules a bit or operating concessionary treatment to try to give sensible results. But it's not particularly satisfying from an analytical point of view. And the main culprit in this analysis, again, is really section 17.2 of the legislation, which says that the market value rule doesn't apply, because it just opens the possibility to Carrie making to the whole of the sum that's received by Carrie being chargeable to tax, rather than just the difference in value over the time that she's held her rights. So the key takeaway in terms of variations in an unadministered estate, really, if it's not possible to read back, and if the administration of the estate hasn't been completed, ideally try not to affect administration in those circumstances, because it can be really difficult to work out what the tax consequences of it are, and you're reliant upon the revenue's concessionary treatment, for which it's quite hard to find a sort of solid legal basis. I have had a couple of cases where I've had to advise on how that sort of settlement is taxed, and it's not particularly easy. So try to avoid those if possible. I think that probably brings me to the end of my time. Thank you very much for attending and listening, and I hope it's been enlightening. I may have a sort of 1 minute for questions if there are any. I'll just pause. Otherwise, feel free to log off, and thank you again for listening. Well, I don't think I've got any questions. It's either because I've covered everything or what I said was incomprehensible. So it's either a good or a bad thing. I think I will log off as well in that case. So thank you again.